Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in the Chinese economy, and specifically to talk about the property sector. If you've been following the channel, you'll know that the property sector has been an absolute nightmare for China over the last few years. The huge property developers that grew up in the first part of this century ran out of cash. They weren't able to access large amounts of debt that they were able to previously as a result of the government's three red lines policy. And as a result of all of this, we've had a situation of limbo where a lot of unbuilt apartments and semi-constructed property is sitting, lying around, waiting for something to happen. And the Chinese authorities have been trying to sort this out. They've actually introduced a variety of different policies. And I recently posted a video talking about the fact that China is now nationalising some of those unfinished apartments. It's allowing local governments to buy them up and then convert them into affordable housing for Chinese nationals. I'm not entirely sure what happens in terms of the apartments that have actually been pre-sold to people and they've got a mortgage on them. I'm assuming that those people will be paid off, but we haven't got any details on that. So China is trying to sort out the supply problem. But one of the main things that it's trying to rectify right now is demand. There has been a complete loss of confidence over the last couple of years from the buyers. People are nervous because property prices currently are falling in China. And in order to try to rectify this, the authorities recently introduced a new stimulus to try to boost everybody's confidence and get people back into the market. And it's now been highlighted by S&P, the rating agency, that this potentially increases the risk to financial institutions in China. So in today's video, I'll have a quick recap of the stimulus measures that were introduced recently by the Chinese authorities. We'll then have a look at what's going on with regards to home sales, house prices, and unsold property inventories. We'll talk about the recent introduction of the new stimulus in Shanghai. We'll have a look at the warning that's been issued by S&P. We'll talk about what's going on with VANKE, one of the largest property developers in China, that recently had to sell some of its land at a huge loss. And then finally today, I'll wrap up with my summary as to what I think is going on in the property market right now, what's likely to happen over the course of the next 6 to 12 months, and what the impact of all of this is on the Chinese economy. But before we get started, I'd like to say once again, thank you so much to everyone that's supporting the channel. If you're a long-term supporter of the channel, either through Patreon, where you can get early access to my videos and watch them advert-free, or YouTube membership, where you can also get early access, or buy me a coffee membership, thank you for that long-term support. It really helps to keep me motivated, keeps me focused, keeps me posting more videos. And if you've bought me a coffee or sent me a YouTube super thanks recently, thank you for the time and effort you've taken to do that. Really appreciate it. I do read every single one of those messages. I don't get time to respond to all of them, but thank you for sending them through. It really helps to keep me going. Over the last 20 years, the Chinese property sector has contributed around 25% of China's total GDP. This has been a huge growth engine for China. As more and more cities started to expand and become developed, more property started to be built, and Chinese consumers were desperate to get onto the property ladder because property prices were only going one way. And this was all being fueled by debt. The property developers were taking on huge amounts of debt that were being provided by the Chinese banks, and Chinese individuals were also taking on huge mortgages to pay for those properties. Now in 2020, the Chinese authorities became concerned that the developers had too much debt, and they introduced the three red lines policy, which restricted the amount of debt depending on the economics of each individual property developer. But unfortunately, from the Chinese authorities' perspective, they made these rules a little bit too tight, and a lot of the major developers defaulted, which meant that they could no longer access that debt, and they therefore couldn't complete all of the builds that they'd started, and everything came to a grinding halt. And because of that, a lot of Chinese individuals were left with mortgages on properties that they'd bought in advance of being built, and unfortunately for them, they're now paying mortgages on properties that don't exist. And the result of all of this was a complete loss of confidence in the sector. Prices started to fall and consumers became very nervous about property. And that's the situation that the Chinese property market is in right now. Now, in order to try to sort this out, the authorities have introduced a variety of different initiatives over the past few months. One of the first things they did was introduce a whitelist, which encouraged the banks to provide more debt finance to the property developers. However, the banks have been very reluctant to follow through on that because the loans that they're making aren't guaranteed by the state. They are still commercial loans. And at the end of the day, if you provide a large loan to a property developer right now, the payment on that loan is going to be dependent on selling all of those apartments. And when you've got a market that's in free fall where prices are dropping, there is a big risk that those developers won't recoup enough cash and therefore they won't be able to repay those loans. And so banks are very nervous about putting more money into a sector that is currently doing very badly for them. So that whitelist hasn't really had the desired impact. So one of the other things that the Chinese authorities have now announced is that local governments will be allowed to buy the unfinished and semi-finished apartments, give the money to the developers to complete those builds, and then take that property and provide it as affordable housing. So basically, this is a backdoor way of nationalising all those unfinished apartments. So the benefit of that process will be that the developers are able to continue trading. They'll still be able to employ people. They'll be able to complete those builds. But ultimately, the Chinese state is paying for those properties. It isn't stimulating the property market. It's not bringing buyers back into the game. So in order to try to do that, what they've done is introduce two different initiatives. The first is that they've told the banks to lower mortgage rates, reduce them to make it more attractive for people to take on more loans. And they've also, alongside that, said that the deposit required on properties will also be reduced. So what China is trying to do is make it easier to buy property. You don't have to have such a big deposit and you can borrow very cheaply now. But will that turn things around? If you were in China right now and somebody offered you a low rate mortgage with a low deposit, would you put your life savings into the property market? I certainly wouldn't, because when you look at the fundamentals, the prices are going down and stock is rising. So let's have a look at some of the fundamentals of the market right now. This chart shows the movement in China's new home prices dating back to 2015. And the scale on the left-hand side of this chart shows the percentage movement and goes from minus 10% at the bottom to plus 10% at the top. And what this chart shows is that prior to the current period, the last time that property prices in China fell was in 2015, when they fell at a maximum rate of around 7%. And the reason for the price falls at that time was because of the slowdown in the global economy. However, as you can see, property prices soon recovered in the second half of 2015, and by the early part of 2016, they were increasing by around 12%. And between 2016 and 2022, property prices increased in every single month. You can see that all of the chart is above the zero line. However, since the introduction of the three red lines policy in 2020, there has been a continued and rapid decline in property prices. And property prices actually started falling in real terms in 2022. And the current position is that year-on-year property prices are down by 3.1%. And you can see in 2024 that the fall in prices is accelerating. We've got a very steep line here. And these three charts highlight the loss of confidence in the property sector in China that's been going on now for over 2 years. The first of these charts show property sales by floor area, and you can see that this metric has been in negative territory for the last 3 years. It fell by around 25% in 2022, 8% in 2023, and so far this year it's down by more than 20%. As a result of the fall in property sales, property investment has also been reducing in the last 3 years. It was down by 10% in 2022, 9% in 2023, and so far this year there has been a year-on-year fall of almost 10%. And when you consider that the year-on-year figures here are measured against the results for the previous year, the last couple of years have been very poor in terms of the level of property investment. And the story with regards to the amount of funds raised by property developers is the same. In 2022, there was a fall of over 25%. In 23, it was down by around 13%. and year to date in 24 it's down by almost 25%. And this graphic provides a visual illustration of the size of China's unsold housing inventory right now. And this is actually something that's quite difficult to get your head around. The very small squares on this graphic represent 1 million square meters of land. That is a very large amount of land. And when you look at this grid, it shows us the total amount of unsold housing. And to put the scale of this into perspective, the small square highlighted in the bottom right-hand corner of this graph is the entire square meterage of Manhattan, 59 million square meters, and the large square on the left-hand side is the entire square meterage of London, which is 1.57 billion square meters. So the total amount of unsold housing inventory in China is bigger than London and Manhattan combined, and in fact, you'd have to have about 15 or 20 Manhattans here to make up the difference. And this chart provides us with a good understanding as to what's going on in China right now. The pink bars on this chart show the level of stock that the property developers are sitting on, so the amount of property that's unsold. The purple bars show the level of new home sales, and the black line on this chart shows the ratio between inventory and sales. So if we start off by looking at new home sales, you can see that between 2010 and 2021, there was a general increase in new home sales. There was a slight small dip in 2014 and 2015 as a result of the dip in the global economy. But overall, if you're looking at the trend in that period, it is increasing new sales. However, as we can see in 2022, 23 and 24, new home sales have fallen in every single year, and the full year estimate for 2024 is expected to be the lowest at any point in the last 15 years. And this really follows on from what we've just been talking about. Now, if we look at the inventory levels, you can see that in 2010, the inventory levels weren't actually that much greater than new home sales. Developers were not building a lot of property speculatively. They were taking orders, building those apartments, delivering them to customers, and then taking more orders. However, in the period between 2010 and 2015, the property developers started to build a lot more speculative inventory. And by 2015, the total amount of inventory that developers were sitting on was more than double the amount of new home sales. So what we've got here is a situation where the developers were taking on more and more debt, and they were building more and more apartments that weren't sold. Now, interestingly, in 2016, 2017 and 2018, the situation did improve. New home sales increased, and the level of inventory started to come back down. And there was an improvement in the relationship between inventory and sales. And you can see this in the ratio, which is shown by the black line. It came down between 2015 and 2018. However, in 2019, 2020 and 2021, it started to increase again. And you can see that the level of inventory started to increase relative to the level of sales. However, you can see that in the last 3 years, the relationship has gone off the scale. We have seen an increase in total inventory and a large fall in new home sales. And this is one of the main reasons why the property sector is in a complete state of disarray now. If we compare the figures for 2024 against the figures for 2010, back in 2010 there was a very close relationship between the level of inventory and the level of sales. Developers were acting cautiously. If you look at the situation for 2024, the level of inventory is around 3 times the amount of new sales. The developers are sitting on huge portfolios of unsold property that nobody wants to buy, and prices are falling, and that means that they're going to have to keep cutting the prices in order to try to sell these properties, which is going to cut into their profit margins. In fact, most of them are moving into a loss-making situation, and when you've got a huge amount of debt, you can't do that because that debt needs to be serviced. You have to pay the interest, you have to make the repayments, and so this is why a lot of these developers are now illiquid and are becoming bankrupt. As a result of the recent changes introduced by the Chinese authorities, Shanghai has become one of the first major cities in China to announce a variety of different initiatives to bring buyers back into the property market. Shanghai has lowered the minimum down payment ratio for first home purchases to 20% and cut the ratio for second home purchases to 30% for suburban areas and 35% for the rest of the city. The down payment ratio previously for first home purchases was 30% and 40 to 50% for second home purchases. It's also announced that it will cut the minimum interest rate on first home mortgages to the loan prime rate minus 45 basis points compared to the current level of plus 10 basis points. The city will also relax home buying restrictions for non-Shanghai residents by shortening the number of years of social insurance and income tax payments required before buyers become eligible. It will also abolish restrictions on home purchasing by divorced couples. Now, I think the most interesting initiative that Shanghai have introduced is changing the mortgage rate to being minus 45 basis points below the lending rate. So what this means is that potentially banks are now losing money on that money because they're having to borrow that money in the money markets at the lending rate. And then if they're lending it to new buyers at less than that lending rate, they're having to fund that difference. And the reason that they're doing that is that they believe that over the long term, this will be beneficial to both the bank and the economy. This could be seen as a loss leader product. But the problem that this now raises is what's going on in the property market. And this is something that I'll come on to talk about later in the video. The S&P have highlighted that if the market keeps falling, these banks are now at risk of losing huge amounts of capital. But in terms of looking at whether or not this lower mortgage rate is likely to be beneficial to the property market, I wanted to have a look at some stats. This chart shows the impact of mortgage rates on property sales in China. The purple line on this graph shows the weighted average of mortgage rates in China, and the scale is measured on the left-hand side and goes from 2% at the top to 9% at the bottom. And the black line shows the year-on-year percentage change in property sales and is shown on the right-hand scale, which goes from minus 20% at the bottom to plus 50% at the top. And what we can see here are two really interesting trends. Between 2009 and 2022, there was a close correlation between the movement in the weighted average mortgage rate and the percentage increase in property sales. You can see that the purple line and the black line are moving relatively closely to each other. There have been some periods when one has moved faster than the other. However, broadly speaking, they're moving in the same direction. If mortgage rates go down, then that tends to lift property sales. If mortgage rates go up, then it tends to have a negative impact. However, if we look at the situation over the last 2 years, there is a complete disconnect between these two lines. Over the last 2 years, on average, mortgage rates have reduced significantly. They've come down from a weighted average of around 5.5% to the current level of around 3.5%. However, over that same period, property sales have nosedived. In 2022, the year-on-year movement was positive around 20%. However, now it is down by around 15%. And what this tells us is there is now a disconnect between mortgage rates and buyer demand. People will not be encouraged back into the market just by being offered a cheap mortgage. And the reason for this is because property prices are falling, buyers have lost confidence, and so it doesn't really matter what price you offer them for the mortgage, they're unlikely to want to buy if they think that prices year on year are going to continue going down. As I mentioned at the start of today's video, S&P, the rating agency, believes that the recent stimulus package that's been introduced by the Chinese authorities to try to boost the property market increases the risk of losses for banks. And the reason for this is twofold. Firstly, there's been a reduction in the mortgage deposit, so the banks have less coverage. They're providing a higher percentage of the purchase price as their loan. And secondly, the amount of interest that they're receiving is going down. And the reason that this increases the risk is because if the property market continues going down, the banks could find themselves in a situation where they're in negative equity. The amount of their loan is actually more than the value of the property. S&P's recent report states that recent measures to fix China's property slump may hit some lenders. S&P believes a relaxation of down payment requirements, so the deposits, will temporarily increase demand for mortgages, but could stress some banks if house prices continue to fall. This table shows S&P's forecast for house prices in China split out by the different tiers of cities for 2024 and 2025. And what this shows is that S&P is forecasting that primary housing prices will fall by 6% in 2024 and a further 2% in 2025. Tier 1 cities, so the biggest and most attractive cities in China, will be most protected. They're only expected to see a 2% fall in 24 and no fall in 25. Tier 2 cities, which are the second most attractive, are expected to fall by 5% in 24 and remain flat in 25. However, Tier 3 cities, which is where S&P have the most concern, are expected to fall by 9% in 24 and a further 5% in 25, so a cumulative fall over those 2 years of 14%. And S&P have stated that given that first-time home buyers will now only have to make a 15% down payment, they could plausibly be pushed into negative equity if prices continue to fall in the third year of ownership. That may trigger some who have multiple first homes to walk away from their units and default. Banks would then be left holding onto houses that are worth less than the mortgage loans. The removal of floors on mortgage rates will also give lenders less buffer to absorb potential losses when defaults do happen. If home prices fall through the 15% threshold, pulling people into negative equity, borrowers with multiple first homes in this scenario would have a greater incentive to halt their mortgage payments. This would be particularly the case if they had less confidence in their income or job prospects. First-time homebuyers typically live in their homes and are therefore less likely to give up their residence even if the value of their home is underwater. However, the definition of first homes is loose in China. Buyers who own residence in other cities may be categorized as a first-time buyer when purchasing a unit in a new city. Some of them may not be living in their homes and may abandon their purchases in a negative equity scenario. This will test banks' risk management. Lenders will need to correctly identify the buyers of primary residences and raise the down payments and mortgage pricing for those that are not. Cash-strapped China VANKE, one of the largest property developers in China, has sold a Shenzhen land plot via auction for 2.24 billion yuan, which is around $310 million, which is more than 27% below the price it paid for the same 19,000 square metre block nearly 7 years ago. VANKE is working to raise funds after saying last month that it is facing short-term liquidity pressure, one of the many companies to have been caught up in a broad-based cash crunch in China's crisis-hit real estate sector. Interestingly, its largest shareholder, state-owned Shenzhen Metro, and another Shenzhen-based company jointly bought the plot at VANKE's reserve price. This was the only bid for the asset, which VANKE bought in late 2017 for 3.1 billion yuan. So what we are seeing here is another situation where the Chinese state is bailing out its developers through a backdoor method from buying land that VANKE owns at a massive discount. This is basically a situation where the state is buying back something it sold to VANKE 7 years ago at a lower price. So what's the summary and conclusion today? Well, I wanted to post this video because I think what's happening right now with the Chinese property market is absolutely fascinating, and it's also absolutely critical for the Chinese economy. As we've discussed many times before, the property sector historically made up around 25% of China's GDP. Now, China is forecasting 5% growth in GDP for 2024, and therefore it needs the property sector to grow by 5% to contribute its fair share. If the property sector actually continues declining at the current rate, if it's double-digit decline, 10% or 15% down, then basically what that means is that China is going to have to find significant growth from some other area of its economy in order to make up the loss that property is contributing. And unfortunately, from China's point of view, the rest of the economy isn't doing particularly well at the moment either, because exports are struggling. It's struggling with regards to inflation or potentially deflation. It's teetering around those levels month on month in 2024. And global demand for China's products isn't as strong as it was historically. So China is running the real risk of not hitting that 5% GDP target if the property sector underperforms. Now, what the Chinese authorities have tried to do is sort this out in two ways. Firstly, it tried to provide loans to the developers in a different way. Because of the three red lines, which have restricted the amount of traditional lending, the Chinese authorities are now effectively nationalising a lot of these property development assets. They're allowing the local governments to step in and buy these unfinished apartments to clear some of the inventory that we saw in the graphs earlier. There is a huge disconnect at the moment between the amount of stock that these developers have and the amount of new home sales. And the reason for that is because there's a complete loss of confidence. And obviously, when a market starts to fall, when you see falling prices, it puts you off buying. When you see month on month falls in those prices, it's unlikely that you're going to be encouraged to dive in and start buying a whole lot of property because you don't catch a falling knife. That's the old adage. And that's the situation we've got in China right now. Now, the authorities are trying to turn that around, and they're doing it by making it more attractive to take on a mortgage. So you have to put down a lower deposit and you can get a cheaper rate now. But as I discussed earlier in the video, that wouldn't encourage me to buy in a market that's in free fall, because even though it might be cheap borrowing and you don't have to put as much of your own money in, you're still on the hook if that property goes down in value. You're still going to have that debt, you're going to have to repay it to the bank at some point, and if the value of the property is worth less than the mortgage, you're in negative equity, and nobody wants to be in that situation. So what China is doing right now is a way of trying to encourage people back into the market, but I don't think that it's going to be effective. And the stats that we've seen today show us that there is now a big disconnect between what's happening with mortgage rates and what's happening with new home sales. People are not being coaxed back into the market just because it's a little bit cheaper. And all of this is really bad news for China, because if the property sector does continue doing what it's doing so far in 2024 for the rest of the year, this is going to cause them major problems. They're going to have a huge black hole in their economy that it's going to be really difficult to fix. And the overall summary of today's video is that the property sector right now in China is struggling. It's been struggling for a long period of time. As we saw from the data earlier, property investment is down over the last 3 years, and so is the amount of funding that developers have been able to access. So that means that supply is starting to dry up. But unfortunately, from China's point of view, demand is also drying up. People are nervous about property at the moment in China, and lowering mortgage rates and deposit levels is unlikely to fix the market. It may bring some buyers back in, but it's nowhere near enough to be able to put this sector back into a growth situation. So all of this means that property is now likely to contribute significantly less than 25% of total GDP in 2024. In order to hit its growth target of 5%, China is going to need to find another sector to fill that gap, and that's going to be very challenging, and therefore the 5% GDP target for 2024 now looks in question. So hopefully you've enjoyed today's video, you found it interesting, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.